Welcome to the Stock Market Palantir. Today we are going to talk about SRW.
Ah, yes. SERV Robotics.
Exactly. SERV Robotics, Inc. they're right at the epicenter of this emerging physical AI landscape. They're a really critical player in autonomous last-mile logistics, and, they've recently achieved some undeniable operational success.
Undeniable, sure. The numbers are there.
Yeah, we're talking about a firm 2,000 robot deployment mandate, sequential delivery volume growth hitting 66%, and the strategically crucial acquisition of Vebu. And yet, despite all this fundamental progress and key backing from giants like Uber and NVIDIA, the stock has been just dramatically volatile.
Especially since its reverse merger and the big capital raises.
Right. Is SERV's long-term valuation fundamentally determined by its proven technological moat and its operational growth? Or is the stock's performance just completely dominated by technical factors, specifically the complex market microstructure and the very acute impact of share dilution?
I think that's the perfect way to frame it. Because look, I'll concede, the fundamental story is compelling. It's a high-growth sector. No one's debating that. But my core argument is that the valuation and the near-term price action are right now dictated almost entirely by the mechanics of the market. The structural forces at play, the persistent supply overhang from the offerings, the mechanical shorting pressures, those are the unavoidable drivers of risk that investors really have to prioritize.
See, I come at it from a fundamentally different perspective. I view SERV not just as a logistics company, but as a quintessential venture capital investment translated to public markets. This company possesses a really significant technological and strategic moat that, in my view, justifies its current valuation as a high-beta derivative play on the future of the autonomous economy.
Okay, so unpack that moat for me.
Well, let's dissect it. They are positioned perfectly at the nexus of generative AI and robotics. They're using the NVIDIA Jetson platform, which is essential for pushing their autonomy stack toward true Level 4 capabilities. And look, this isn't just about moving packages from A to B. It's about turning every single deployed robot into a sophisticated data acquisition platform, gathering the proprietary spatial data you need for scaled automation. This technological advantage is substantial, and it's very, very difficult to replicate.
The technological promise is undeniable, I'll give you that. But the finest technology in the world can be completely crushed by an inefficient capital structure. Let's look at that operational traction through a financial lens. You cited a 209% year-over-year revenue increase in Q3 2025. That's a rapid rate of change.
It's huge.
It is, but what was the absolute revenue figure? It was only $0.69 million. So when we contextualize that tiny absolute revenue against a market cap hovering around $600 million, the stock is pricing in a decade of absolutely flawless execution.
But that analysis fails to appreciate the value of the ecosystem building and, crucially, the financial security they now have. The expansion of their partnerships to include DoorDash alongside Uber Eats establishes SERV as a truly neutral utility.
A neutral utility, right?
Exactly. This maximizes robot utilization by allowing them to service batched orders from competing platforms, which is just essential for unit economics. And then let's talk capital. That $100 million registered direct offering gave them a cash position of roughly $210 million. That is a fortress balance sheet. This cash removes any near-term financing risk entirely and provides a runway well into 2027, maybe even 2028. This liquidity premium gives them the time to achieve the commercial density of that 2,000 robot fleet without the distress signals that plague their small-cap peers.
I'm sorry, but I just don't buy that the cash raise is an unalloyed positive for the stock price in the near to medium term. While they secured liquidity, which I agree is strategically necessary, the stock's valuation is, it's being held captive by an intricate and inherently unstable capital structure. It's defined by a persistent supply overhang. The company's non-traditional path to public markets, the reverse merger with Patricia Acquisition Corp., and then immediately issuing this massive tranche of shares in that $100 million raise, It significantly expanded the total share float to approximately 67.8 million shares. This is the structural reality. You have a vast increase in available supply that mechanically acts as a price suppressant.
You're focusing purely on the mechanical quantity of shares, though, and you're ignoring the value of the execution runway that capital provides.
You have to focus on the reality of the dilution and the financial burden that comes with it. I mean, the company is definitively pre-profit. It's exhibiting a high cash burn, estimated between $10 and $15 million quarterly. The widening net loss, the 54-cent EPS loss in Q3, underlines that profitability is a distant target, likely years away. So while the $210 million is fantastic, every single share issued to secure it comes at an acute cost. This structural burden, paired with market microstructure headwinds, places a concrete ceiling on any potential rally.
Okay, let's drill down into that specific structural cost you mentioned. The mechanics of the $100 million raise. I see why you characterize the issuance of shares and warrants as a persistent supply dampener. So explain the mechanism here, because this is where all the complexity lies.
It is the essence of the structural cost. So the institutional participants in that registered direct offering, they purchase units containing common stock and associated warrants. Now, these investors are often focused on generating safe returns and managing risk, not necessarily holding the stock for the long term. To neutralize the volatility risk, the delta risk that's associated with their long warrant positions, they immediately short the underlying common stock. It's called delta hedging.
Okay, so essentially, they're buying the right to acquire shares cheaply later, but they immediately sell shares today to lock in a profit margin regardless of what the price does in the short term?
Precisely. They create mechanical sell pressure that is just continuous and relentless. And what's more, they are sophisticated. This hedging activity is often routed off exchange into dark pools to minimize the immediate market impact. But that constant synthetic selling is why the market capitalization has expanded so much, even while the share price looks stagnant. It makes the stock effectively more expensive for any new long-term investor because they're fighting this built-in supply.
That's a powerful point about the structural shorting inherent in these capital structures. However, I would frame the dilution as a necessary and temporary mechanical digestion of new equity. That capital secured the 2000 robot mandate and the Vibu acquisition. These are the foundation for the commercial density that will eventually become the true valuation driver. I mean, we have to contrast SERV's financial safety with distressed peers like a company, like Nauticus Robotics. SERV now has the luxury of time. This liquidity premium lets them survive long enough for the commercial results to overcome the mechanical supply. The dilution is a temporary fee paid for long-term survival.
Time is a luxury, yes, but the volatility it creates is a severe deterrent. Let's move to the heart of the retail squeeze thesis, what you called the dark pool enigma. Your perspective suggests this constant short volume is a vulnerability. I argue it's just standard operating procedure for market makers.
But the data suggests vulnerability. The regulatory filings, specifically Reg SHO presence, and the fails to deliver, or FTD data, show significant spikes. We're talking sometimes reaching $2.71 million in 15-day windows. Persistent FTDs strongly suggest that legitimate lendable shares are becoming scarce. The status of hard to borrow implies the current equilibrium is fragile. If a major positive catalyst materializes, say the start of Magna Manufacturing or a new large contract, short sellers face a double whammy. A sharp rise in stock price coupled with skyrocketing borrow fees. That is the definition of a potent squeeze setup, even if it is.
But is it really a squeeze setup? I'm not convinced that interpretation of high short volume, which consistently sits between 45 and 60% off exchange, translates directly to aggressive manipulative bets against the stock. We need to distinguish between intentional short suppression and, well, structural market efficiency. A very large portion of that volume is what we call wholesaler internalization.
Okay.
So when a retail investor puts in a buy order for SERV on a platform like Robinhood, the wholesale market maker often steps in and sells the share to the client immediately from their own inventory. They do it to guarantee the best price and execution speed. That initial sale is technically classified as a short sale. They then cover that short position later, often routing the trade through a dark pool.
So it shows up as short volume in the data, but it's essentially just rapid inventory management, not a directional bet against the company?
Exactly. It is standard liquidity provision. This volume, while it's classified as short, is merely the mechanism for filling immediate retail demand. It's not necessarily an indication that sophisticated players are trying to fundamentally suppress the price. It's a mechanic, and it creates a persistent synthetic supply that just confuses the narrative. And, we also have to acknowledge the exempt short sale allowance. Market makers are permitted to short the stock even on a downtick if they are maintaining liquidity. These are legal, structural mechanics often misinterpreted as manipulation, which just fuels that whole squeeze thesis, when the reality is far more algorithmic.
I accept the nuance regarding internalization, but ultimately, these technical pressures are just noise if the company can achieve sustainable, scalable unit economics. This brings us back to the execution risk. We have to establish whether the fundamental progress can actually overcome these structural headwinds.
That is the ultimate test. My primary concern here is the teleop trap. The economic viability of the entire fleet hinges entirely on driving down the human supervisor ratio, the teleoperators, who remotely take control when a robot gets stuck. If the company cannot reduce that reliance significantly, say moving from a 1-to-5 robot to human ratio to 1-to-50 or 1-to-100, the cost of remote labor will quickly exceed the average delivery fee. That would sink the unit economics entirely. That is the existential risk. And we also face severe manufacturing execution risk. Scaling the fleet from a few hundred prototypes to a mandated 2,000 robots is a massive logistical challenge. If there are delays in the Magnum manufacturing line, the company could easily miss its projected $60 to $80 million run rate for 2026, which would instantly delegitimize the current market cap.
I see why you focus on the cost side, but let me reframe the valuation paradigm entirely using the RaaS, or Robotics as a Service model. This shifts the emphasis away from the gross delivery fee.
That's an interesting pivot. So you're arguing the core value isn't the delivery itself.
Precisely. The value is decoupling from mere delivery volume through the successful monetization of high-margin secondary revenue streams, specifically branding revenues, which were up a remarkable 120% sequentially in Q3. This is critical because this type of high-margin advertising revenue, which typically carries 80 to 90% gross margins, will eventually push SERV's blended gross margins closer to software levels.
Right.
The RaaS model implies they charge for the utility and the data, not just the physical movement. If they can achieve this revenue mix, it justifies a premium software valuation multiple over traditional low-margin hardware peers like rich tech robotics. The robot becomes a mobile, monetizable billboard and data collector.
That's compelling, assuming they achieve density. But where does the Viaboo acquisition fit into mitigating that teleop trap you were talking about and bolstering the RaaS margins?
Viaboo provides the crucial piece of the puzzle: internal automation. The Viaboo acquisition gives SERV an intelligent hardware module that can automate tasks inside the restaurant kitchen. This extends the cost savings beyond just the last-mile delivery. So instead of a human handing the package to the robot outside, Viaboo automates the entire kitchen-to-doorstep vertical. This reduces human touchpoints, drastically lowering operational friction and execution risk, and an improved speed. Ultimately, it allows them to increase the RaaS pricing because they offer a more comprehensive, seamless automation solution to their partners.
So Viaboo helps them leapfrog the physical bottleneck that exists before the robot even hits the sidewalk. That's a sophisticated argument for long-term cost reduction. But until those 2,000 robots are actually deployed and generating both delivery and ad revenue, the stock remains vulnerable.
Absolutely. The success hinges on execution velocity, but the runway is secured and the partnerships are in place.
In conclusion, I maintain that investors must remain extremely wary of this complex market structure. While the technological and strategic vision is clear, the complexity of the $100 million dilution and the resulting mechanical supply overhang, those 67.8 million shares, mean that short-term price action will likely remain range-bound and volatile. Incremental operational wins, even 200% revenue growth, will struggle to gain sustained traction against these persistent structural headwinds, until that massive flow is fully absorbed by the market.
And I'll conclude that the long-term potential remains too compelling to ignore. The strategic partnerships with Uber, DoorDash, and NVIDIA, combined with the secured financial runway and proven technological execution in this physical AI space, it suggests that the current valuation, which is heavily suppressed by these technical market mechanics, is potentially an attractive entry point for investors with a time horizon extending past 2026. This is a bet on the long-term digestion of equity supply being won by fundamental growth.
The ultimate success of SERV robotics depends entirely on the speed and efficiency at which their operational density and high-margin RaaS revenue can overcome the structural headwinds imposed by their recent capitalization events.
A perfect summary.
Thank you very much for hearing us. Let us know in the comments what is your opinion, and if you want us to analyze other stocks. Don't forget to subscribe to the Stock Market Palantir channel to catch up with more stock insights, and see you in the next video.